Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. A lot's happened since the last recording. The market did break to a new high. Bond yields have calmed a bit thanks to a great 20-year auction today. And Bitcoin looks ready to break higher again. Let's take a look at the charts. If you're new to the channel, be sure to subscribe to get all the market updates before the next trading session opens. At the time of this recording, it is 2:05 a.m. Eastern Time on Tuesday night / Wednesday morning. Currently, the futures are up 50 basis points, so nothing going on in the futures. But a lot's going on in the market, or has since the last time we talked. As I said in the intro, the market broke to a new high. Here was that previous high that we had talked about in the last recording that we wanted to see the market break above, and it did so with a new trading high and closing high that occurred on the 11th of March. The next day, it's not much of a follow-through day, but yesterday's trade was a good follow-through day. Today, a little bit of pullback. You can see that if I take this line away, we did have a little separation from the 10-day moving average. You know what that means. I don't need to give you the phrase again. So a little bit of a pullback, not unexpected, especially with the fact that we have a big Federal Reserve meeting tomorrow. This has been a two-day meeting this month, so they met today, and then tomorrow they'll give their statement at 2 p.m. Eastern Time, as they always do. So a little bit of wondering, is the Federal Reserve going to up their estimate on GDP, or are they going to keep that same mantra of keeping the pedal to the metal all the way until 2023 before considering even the thought of, remember they're not even thinking about raising rates? Were they going to take one of those thinking abouts away? We'll find that out tomorrow. But the most important thing that occurred this week happened today, and that was a huge 20-year bond auction. The bid to cover was over 2.5. By reference, it's been around 2.3. If you're not sure what the bid to cover is, that's a measurement of demand. It's how many bids there are for each treasury or bond or whatever is being offered. So over 2.5 means there are 2.5 bids for every security, every 20-year treasury being auctioned today. That's strong demand, the highest it's been in a very long time. Bonds work the same way, supply and demand. As demand increases, prices go up. With yields, as prices go up, yields come down. Remember in the last recording, mentioned that David Tepper had said he thought that bond yields may have peaked for now. We showed the DMI, which was giving a very strong ADX, telling us that the strongest part of the move was likely over for that point in time. Again, it doesn't mean the entire move is over. The strongest part of the move is over. And bonds did creep up a bit since the last recording, but not a whole lot. And they do appear to be stabilizing. And on this 20-year TBT, we haven't looked at that as much, has a gap right here. And then we add the moving averages on and just a little bit overbought as they have been in the past. So a little bit of consolidation is warranted. There's really not much of a sign from the ADX that a significant move to the upside is going to occur from here. So perhaps we are getting to the point where bonds can stabilize enough to allow the stock market to go up. The reason I talk about bonds, and I do this all the time, is it's been my mantra that if you want to be a good equities trader, you have to understand the bond market. A lot of people ask, why? Why are bonds so important to the stock market? Especially the 30-year is what people look at because it's a mixture of inflation and economic growth. That's basically what the 30-year is. Now, the Federal Reserve seems to think that they can control the long end. I don't really think they can. And a lot of smart people that I know agree with me that they don't think that the Federal Reserve has as much power on the long end as they think they do. So that's why it's so important to keep an eye on that as far as what are the signs coming? Is inflation coming or is growth coming? That's the key. With rates moving up, and no doubt rates have been moving up, so whether or not they begin to stabilize now or not, there's no question that they've been moving higher. Are they moving higher based on expectations of inflation increasing faster than people thought, or are rates increasing because growth is going to be stronger than originally thought? Those are two very different scenarios. If it's because inflation is getting ready to come and it'll be faster than people thought, that's bad for the equities market. But if growth is coming and growth outpaces inflation, that's good for equities, and that determines where you want to put your money. So we'll be watching to see which of those two scenarios plays out, and the market's going to give us a pretty good idea. I'm curious as to what you think. Why do you think rates are going up? Inflation's going to be hotter than expected, or growth is going to be better than expected? Leave me a comment. Let me know. Be interested to hear from you. So that's the important thing that's been going on in the bond world. And look at that ADX, still going up, but way above 50, and to the point where even if yields went up a little bit, just don't think there's going to be a significant move from here, at least not in the near future. And that could give the equities market that opportunity to go up to that 420 level that we've been talking about so often, up here, the top of that zigzag pattern. But we have to get past 400 in the meantime. So that's going to be possibly a little bit of resistance. Maybe the shorts trying to make a stand there. We'll see. But once we get to 420, then that analysis that I just went through regarding what's going on with rates, what's going on with inflation and GDP growth, all that stuff becomes ultra important. That's the things that we'll be looking at Elliott Wave Options to determine what to send out to our subscribers as far as alerts, where to go from here, as far as forecasting the market to move higher or lower. Taking another look at the dollar has stabilized a bit. We said we thought it might consolidate. It did go just a bit higher, but now it has consolidated back towards that 10-day moving average. So that's as expected. And we can see we've traded through the 10-day moving average previous two trading sessions today, tapping the 10-day moving average on the low. So stabilization there, very warranted in the US dollar. We'll see if it's able to mount a continued move to the upside. Again, it all plays into that scenario with rates, growth, etc. Bitcoin, mentioned in the intro that Bitcoin looks ready to move to a new high. Take a look at this. So we already had this great Elliott wave pattern. We've talked about that, where the middle of this wave 5 target at 52,000 was hit dead spot on way back on the 17th of February, and we've kind of churned in this area since then. Look, doji on today's trade. Now the other thing that's interesting on the chart of Bitcoin is a zigzag pattern. We just started our zigzag mastery class for those of you that may have been in it. A really good first session kind of review, and then we get into the nitty gritty. But take a look at this. So on the high in yesterday's trade, we hit that 61.8% fib level dead on the nose. And look what happened. We backed off. So we came back. We've tested the previous fib level at 38.2 on the low, close to the upside for that doji. Now it looks like Bitcoin is ready to continue, extend that wave C up to the 100% extension, which takes Bitcoin over 70,000. We look at the DMI, you can see the ADX is curling up. You do want to see that positive directional indicator get back in gear and get above that ADX for that continued move up to 71,000. But we had talked in the past that after Bitcoin got to this 52,000, 60,000 was next, and now looks like we're headed to 70,000 on Bitcoin. The other thing, the VIX. The VIX broke support. Is this going to be the time where we come down and we finally break low enough to fill this gap all the way back over here that we've been talking about since the bottom here in August, the bottom in November, December, as well as the bottom in February? Each of those times, the support level held and the VIX bounced to the upside. Will the Federal Reserve say something tomorrow that spooks the market and the VIX jumps again? Or do we come just a little bit lower and close that gap? So if we go right to where the gap is, that's where we need to come down in order to fill the gap in the VIX. So down around 18. This is the best chance that it's had. But with that 10-day moving average, you can see that the VIX is just a bit oversold at this point in time. So a little bit of a bounce back to the upside in the VIX, a little volatility mixture mixed in, could very well occur. Maybe we come down and get extended even further and close that gap before a little bit of a bounce back. This is the one thing that makes you a little concerned to see what happens with the Fed statement tomorrow. Whatever they say, I'll be back to explain it to you. Hope you've had a great week. Look forward to talking to you again next time. Take care, everybody. If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.